Welcome to SuperReturn Asia. I'm Sarah Clarke, coming to you from the JW Marriott Hotel here in Hong Kong, and I'm joined by Florian Kohler, who's the Managing Director of Obviam in Asia. Welcome.
Thank you.
Now, we're here to discuss the key issue today of the terms and conditions. Are all LPs equal? So let's start with exactly that. Are they equal, and if not, why and how?
The short answer is no. And the reason being is that essentially, even though all LPs do subscribe to the same set of legal documentation, we signed the same subscription agreement of the same LPA, of the same shareholders agreement, essentially in practice, each LP might have a different order in the hierarchy of importance with the fund manager. And based on a variety of factors, on the ticket size, on the strategic importance of that LP, they will have a different level in terms of equality, if you want to say, among the various investors.
And so basically, does size matter when it comes to what rights they do get?
So size, I think, is probably the primary function. Obviously, an investor who puts 10 million versus an investor who puts 30 million, the 30 million will have probably more preference and specific rights, which we can get into. But it's not only in terms of size, it also comes into strategic importance. So for example, one of the main interests that a fund manager has in choosing his LPs, at least in terms of the rights he's going to give them, is how useful are they going to be or helpful in terms of his portfolio construction and building. So will this investor be a good partner to co-invest with his funds, is portfolio companies? Will they add value to that portfolio company? Or will actually this investor, would they probably be an exit source for some of these portfolio companies? So these are the kind of considerations that the fund manager has to take into play, which then determines how and what kind of rights they might grant to that LP, whether it be formally or informally.
Okay, so what about disclosure? Is there a push for greater disclosure on what those rights are between the players?
Yes, so technically it comes back to the point that legally we all sign the same documentation. Where you see some divergence are in the side letters. And the side letters have historically been pretty much same generic documents which really just provide clear information rights to an investor. For us, because we operate on behalf of the Swiss Development Finance Institution, we're very much concerned about environmental, social, and governance standards. So historically, the side letters used to be the venue where you could disclose and talk in more detail about what are the ESG guidelines, and especially the reporting associated with that, and how to address that. Now, over the years, these side letters have progress more from just being reporting in ESG to actually specifying some of the information rights that certain LPs have over others. And this could be anything from beyond information rights in terms of co-investments, or actually access to pipeline, or access to other rights. Now, an interesting development that we've seen in recent years is that previously, all these side letters used to be fully disclosed to all the LPs who were entitled to it. So typically, first close LPs or LPs who invest a certain amount could have access to these side letters. Now what we're seeing is that based on your ticket size in the fund, you only had access rights to see what other investors who invested the same amount or less. But an investor who invested more than what you did could have rights that sometimes you're not even disclose, you're able to see, and you have to rely on the fund counsel to provide an assertion that essentially it is nothing that materially impacts your investment.
Okay, another challenge which was addressed on the floor before was looking at co-investments. Is there a push for more of this, and are they finding more creative ways to form these co-ventures or partnerships? But also, what's the challenge involved for managing that?
That's exactly the problem right now. And historically, co-investments have always been granted, let's say, historically to the first close investors or investors who invested a minimum capital commitment, say 10 million. And then it was always at the GP's discretion in terms of how he allocated those co-investments. So if an opportunity came on board, he can look at his pool of maybe 7 or 10 investors who want the co-investment rights and choose which one he thinks is in the best interest of generating strong returns for the fund. So an LP who can offer strategic importance or strategic value. Now, these co-investment rights are being articulated and enshrined probably more specifically in the shareholders agreement, or if not in the side letter, that says that the fund manager has to provide co-investment opportunities to an LP because they invested a certain ticket. Now, this presents an actual problem in operation, because when a co-investment opportunity arises, the promoters of those companies don't want to have 10 different investors along with the fund. They want to have the fund manager, maybe one or two investor who brings in strategic importance. They're not really looking to the fact that the money's going to come. The co-investment will come, the funds will come. They want investors who actually have strategic value. So in practice, what we're seeing is the fund managers, in allocating these co-investment rights, are playing a little bit of a dance with the LPs of saying, well, I would like to give you this opportunity, but the promoters of the portfolio companies want to work with investor X because he can provide a certain level of strategic value that unfortunately you cannot. And then when you start getting into those type of discussions, it creates a sort of disconnect and a discord between the GP and the LP bodies, because you have some LPs who are not happy that they're not given co-investment opportunities, yet they have seats on the advisory boards. And for a fund manager, he has to manage that relationship. He obviously wants to keep all investors happy because he wants them to also reinvest in his follow-in funds. So it becomes a dance that sometimes investors like ourselves, who don't actually execute on co-investment rights, have to step in the middle and play a role of arbitrator.
Giving you another job. But looking at also governance and governance bodies, we talked about this, the positions on those bodies are typically taken up by the large investors, but there's more and more they're being pursued by the commercial investors. How is this a problem, and is it something that's a situation that's, that has some of the industry concerned?
It's a good point. When I started doing this business about 12 years ago, the advisory boards or the advisory committees, which are comprised of the limited partners, the investors, mainly had one function, which was really to address primarily conflicts of interest. Over the years, their roles and responsibilities have expanded somewhat in terms of discussing investment limitations or discussing investment strategy. And that's fine, but where we're starting to see a little bit more interest and changes is that the private investors, the foundations, the family offices, who historically never really showed an interest to be on these advisory boards, are asking to have a seat at the table because they believe that the advisory board provides them another level of transparency and information access that they wouldn't receive in a quarterly report or on a phone call with a manager. So by taking a seat at the advisory board, they attend the meetings where, let's say, pipeline is discussed in more detail in terms of future opportunities of the fund, which is great if your intention is altruistic, that you really are interested in just the governance and transparency of the operation of the fund. Where it becomes a challenge is that when you have investors who do not necessarily probably understand or who want to act on their governance responsibilities on the advisory board, who are passive, which is okay, but if they're there and they're passive because they want to see the deal flow and the pipeline of the fund manager, there becomes a little of a gray area, because a lot of these investors are also co-investing and investing directly in the market. And we as other members of the advisory board need to ensure that there's no one investor there who's essentially opening up himself to take away opportunities from the fund manager. So that we need to manage. And the other aspect is also that the governance body is a governance body, so you're supposed to act in the best interest of the fund. But it's not a board of directors, so there's no fiduciary responsibility to the fund. Each investor technically acts on behalf of his own investor. So when you have private investors who are there and are not taking a role, let's say, in the governance body, when we need to address issues such as conflicts of interest, sometimes it's becoming a challenge to engage them and to have them be engaged in this dialogue, because they, for whatever reason, probably do not want to be engaged. They don't know how to be engaged, or they're worried that if they are seen to come against the fund manager, that might affect their ability to see deal flow and have co-investment opportunities, etc.
Is it a scenario then that the governance bodies or the advisory boards need to address that, or change the regulations as to who can sit on those and be members of that to try and stem or avert problems like this?
It's something I would say I would like it to happen, but I know it will not happen in practice. At the end of the day, the advisory boards are chosen by the advisory board members, and who has a seat are chosen by the fund managers. And the fund manager chooses them primarily on how big of a ticket they put into the fund. So, and even for us, who really do play that strong governance role, if there's an investor who's coming in with a significant ticket, let's say 20, 30 million into a fund, we can't and we do not want to interfere with their ability to be on the governance body. If they want an advisory board seat, they're entitled to it. What we have to then do is that we just have to play a bit more of an active role in terms of the dialogue and the engagement with these parties throughout the fund life to engage them into being more proactive. So in a way, it's a learning process for them. It's a teaching process for us. It does increase a bit the work of the governance body, but at the end of the day, it's all about, we're all in this together. We all have the same interests. We just have to make sure that everyone remembers that at the end of the day, that we all want the same thing. So,
thank you, Florian Kohler, for joining us.
Thank you very much.
That's all we've got time for at SuperReturn Asia, but if you'd like to tune into more of these conversations, you can find us on Twitter. Look for #SRAsia. Thanks for joining us, and bye for now.